All right, Dennis, are you listening? Okay, everybody else, we're good? Everybody's listening? Okay. A put option gives the buyer the right to sell stock at some point in the future at a certain price. Okay? Dennis, everybody else understand that? Okay, so let's reference this to Tesla. Okay? So for example, if I buy, okay, if I buy the 300 strike, let me put a date on this, the Feb 15th 300 strike put in Tesla, this gives me the right to sell stock at 300 anytime up until end of day Feb 15th. Okay? Clear? Everybody follow that? Dennis, you're good with that? Okay, so if I sell a put instead, okay? So if I sell a put, it gives someone else the right to sell me stock at some point in the future at a certain price, right? Right? So somebody else that's the buyer has the right to sell me stock. Okay? So if that's the case, if I've sold a put and someone else can sell me stock, what do I want to happen to the stock? If this happens, what do I want to happen to the stock? Okay, Dennis, if I sell a put, what happens to me? If I sell a put, I'm buying stock, right? If someone assigns that stock to me. So I want the stock to go higher then, right? Or at least not go down. If I buy a put, I want the stock to go down. If I sell a put, I want the stock to stay or go higher. Okay, Dennis, does that make sense? Okay, Dennis, what part doesn't make sense? If I buy a put, it gives me the right to sell stock, right? You understand that part, right? Okay, so let's say you sell me a put, Dennis. I buy a put. It gives me the right to sell you stock at a certain price because I'm the buyer, you're the seller. Okay? And that certain price is the strike price. And in this example right here, we're using the 300 strike. So if I buy that put, it allows me to sell stock at 300. If I sell that put, it allows somebody else who is the buyer of that put to sell me stock at 300. Does that make sense? Does that make sense? Okay, so if someone has the right to sell me stock, what do I want to happen? Well, if I'm going to own stock, I don't want stock to go down. I either want it to stay the same or go higher. Okay? So that's the concept of a put, both long and short, buying and selling a put. The reason we trade spreads, buying one option, selling another, is to limit our risk. Okay, so in this example here, okay, if I buy the 300 put for, let's just say $15, okay, I'm putting out a complete arbitrary amount, I can make how much, theoretically? Okay, if I buy that put for $15, right, Jake, you got it. Okay, if the stock goes to zero and I can sell it at 300, then I would make 300 less the amount that I paid for the put, or I could make $285. Okay? Everybody understand that? Does everybody understand that? Okay. Now, if I sell, let's do it this way. If I buy the 300 put like we did before, but also sell the 290 put, how much can I make? Here's the difference between just trading a put or a call, doesn't matter, just an option on its own, versus doing a spread. Okay, if I have that $10 wide put spread, what is the most that I could make? And let's say, hang on. Exactly, Roger. $10 less the cost of the spread. And let's say I paid $3. Okay, if I paid $3 for the spread. I can make $7. Exactly, William. Okay, because the maximum value of the spread is the difference between the two strikes, or $10. If I paid $3, I have 10 minus 3. The most I can make is $7, even if the stock goes to 0. So that is the difference between just buying or selling an option outright and turning it into a spread. When you trade a spread, what you are doing is managing your risk, hedging your risk. Okay? Everybody understand this? Kind of get it? Awesome. All right, let me wrap up this recording. Let me take a screenshot of this, and I will post this up here. Put explanation whiteboard.